Stop. Put the other tabs aside for a minute. Because what you're about to hear is not background noise, not a cute little silver is up today update, and not another harmless cycle you can safely ignore. This is a signal that the system is slipping into a different phase. And the inciting event is simple, brutal, and easy to miss if you've trained yourself to only look at the price. COMEX registered silver is sitting around 126 million ounces registered. The part of the inventory stack that's actually tagged as deliverable, not the theoretical, it exists somewhere in a warehouse category. The category that matters when somebody shows up and says, fine, then deliver. That does not happen in a healthy market. And here's the part that should land in your chest. If you misread this moment, you're the last to move. If you understand what these numbers mean before everyone else does, you're the one who steps aside before the stampede. The real question isn't whether silver can spike another dollar. The real question is whether you're holding a price exposure or you're holding the thing itself when the plumbing starts to seize. Because once the plumbing starts to seize, the price you see on a screen becomes a suggestion, a story, a negotiation. Meanwhile, the real market, the physical market, starts whispering something darker. It starts charging you a toll to escape the paper world. It starts telling you, in plain language, that supply isn't where you thought it was. And today, you can see that toll in daylight. You have got retail listings for new Silver Eagles floating around $86 an ounce while the futures contract is down in the mid-70s. Think about that. You'd have got a double-digit percentage premium just to get 1 ounce of government-minted silver in your hand. Not a collector piece, not some antique. A standard coin, advertised with high-demand language and delays in a world where the official market is telling you everything is liquid and efficient and priced correctly. That's not a spread. That's a credibility gap. And while you're staring at that gap, the institutional side of this market is doing something else that always shows up near stress points. The exchange is tightening leverage. CME is hiking margins again. That is the house, looking at the players, looking at the volatility, looking at the risk of disorderly moves, and saying, you're going to post more collateral if you want to keep playing. They'll never call it fear. They'll call it prudence. They'll call it risk management. But I've watched enough of these movies to know what it looks like when the casino starts quietly changing the rules at the table. And at the same time, you've got a different kind of pressure building offshore, quiet, structural political pressure, where China is moving to gatekeep refined silver exports through a licensing regime, a bureaucracy switch, a paperwork switch, a nothing to see here change that, in the real world, turns into a choke point the moment the system gets tight. This isn't a theory, not a rumor, and not another boy who cried wolf moment. It's a set of interlocking stress signals, inventories, premiums, leverage tightening, supply chain gatekeeping. And then like gasoline drifting under a door, geopolitical escalation and asset seizures. The kind of sanctions and enforcement actions that remind every serious player on Earth that what you own depends on whose permission you have at the exact moment you need it. So ask yourself something, and don't answer fast. If the system is so stable, why does it keep behaving like a system that's bracing for impact? Let's walk through it like a private briefing, the way a risk manager would want it explained. Clean, unromantic, and without the comforting fairy tales. Start with COMEX registered inventory. Most people done T understand the difference between eligible and registered because they were never meant to. Eligible silver is metal sitting in an approved warehouse that meets certain criteria. It might be owned by somebody who has no intention of selling it. It might be parked there for convenience. It might be collateral for something else. It's silver that could, in theory, be made deliverable, but it's not currently tagged for delivery. Registered is different. Registered is the metal that has been warranted, tagged, and is essentially standing in the delivery line. It is the stuff that can be delivered against futures contracts without somebody having to change their mind. Now hear me clearly. When registered sits low, it doesn't mean the world is out of silver. It means the part of the system that S designed to absorb delivery demand is thinner than people assume. It means the paper market S promised to deliver is leaning on a smaller physical foundation than the headlines would have you believe. And if you've been around long enough, you know why that matters. Because futures markets are built on confidence, not morality, not fairness, confidence. The confidence that if a lot of people suddenly want the real thing, the system can translate paper claims into metal without a fight. Low registered is a stress point. Not the only one, but a real one. 6 figures on a report can look boring right up until it becomes the only line anyone cares about. And that SYI telling you to pay attention to this number, around 126 million ounces registered. That's not running out, but it's not comfortable either, especially when you zoom out and realize how many paper claims can exist on top of that base. Here's the analogy that keeps it honest. Imagine a theater with 126 seats, but there are 1,000 tickets in circulation because the theater has a robust ticket market. People trade tickets. They scalp tickets. They bet on ticket prices. Most of them never intend to sit down. They just want exposure to the price of the show. That works until a big chunk of ticket holders decides they actually want to walk in and sit. Then the theater doesn't have a pricing problem. It has a credibility problem. And credibility problems don't resolve gently. They resolve with sudden rule changes, forced cash settlements, temporary measures, and a lot of people learning the hard way that what they owned was a claim, not a seat. That's COMEX, registered in plain language. And when you combine that with what's happening in the ETF world, the story gets even sharper. Because while COMEX is sitting there with its registered stack, you've got one financial product, SLV, reporting something like 525 million ounces in the trust. Over 500 million ounces. Let that number sit. One ETF, one structure, one stack of paper wrapped around the idea of physical silver, claiming an inventory that's a multiple of the deliverable pile everyone watches. Now, to be fair, the ETF metal isn't COMEX metal. Different system, different custody, different mechanics. And yes, there are processes and audits and bars and all the formalities that make the institutional world feel comfortable. That's the story. The reality is that this is a perfect example of what financialization does to a scarce strategic metal. It takes something physical, something that exists in limited quantities and requires real logistics to move, and it turns it into a permissioned claim that trades like a stock. That's not inherently evil, it's just a fact. But facts become dangerous when stress arrives. Because in calm markets, everyone accepts paper. In stressed markets, everyone suddenly remembers why physical exists. The real question isn't whether SLV has silver in some abstract sense. The real question is what kind of silver it is from your perspective. Is it silver you can access? Or is it silver you can't touch because you don't meet the redemption thresholds, you don't have the right counterparties, you don't have the right status, and you don't have the right legal pathway? Because most people don't own silver through those products. They own exposure, and exposure is fine until it isn't. You know what exposure feels like in a crisis? It feels like watching your account statement behave normally while the world behind it stops behaving normally. It feels like being told everything is orderly and functioning as designed, while behind the scenes, the people with real pull are quietly converting claims into collateral. I've seen that pattern in other markets. Different asset, same playbook. In 2008, people learned that not all dollars were equal. That sounds crazy if you've never lived through it, but it was real. Some dollars were stuck in failing institutions. Some dollars were insured and accessible. Some were frozen. Some were promised. The idea of money fractured into categories, that's what stress does. It fractures the thing you thought was singular into tiers. Top-tier collateral, second-tier promises, third-tier hopes. And silver is uniquely positioned for that fracture because it lives in two worlds at once. It's monetary metal, yes. It's also industrial feedstock. It's in solar, it's in electronics, it's in the high-tech nervous system of the modern economy. So when supply tightens, you don't just get a shiny metal story. You get an input cost story, you get a bottleneck story, you get a political story, which brings us to China. People hear export licensing, and their eyes glaze over because it sounds like paperwork. But paperwork is how systems enforce power without firing a shot. When a major node in the supply chain decides refined silver exports require licensing, what they're really doing is creating a valve, a controllable point of restriction. It might be open most days. It might be open during calm conditions, but it's there. And in a tight market, a valve becomes a weapon. This is not new behavior. This is what resource nationalism looks like in the modern era. Not tanks, not speeches, valves. And Donna T, misunderstand me. I'm not telling you China is banning silver tomorrow. I'm telling you that when the world is moving deeper into strategic competition, industrial metals and monetary metals stop being just commodities and start being leverage. Silver sits right in that crossfire. And the timing matters. And this licensing regime is live now at the beginning of 2026. That's not a distant possibility. That's a current framework. In a loose market, it's an administrative detail. In a tight market, it's a choke point. What does that tell you? It tells you the world is preparing for constraints. It tells you the assumption of frictionless supply is getting risk managed out of the system. It tells you that the people who actually control flow are positioning themselves to control it more tightly. Now, add the margin hikes. You need to understand what margin hikes mean psychologically because that's where the story turns from data into behavior. When an exchange hikes margin, it's forcing participants to post more collateral to hold positions. That hits longs and shorts, but the real effect is this. It punishes leverage. And leverage is the lifeblood of paper metals trading. The paper market works because you can control a lot of metal with a relatively small amount of money. That's not a moral judgment. That's how futures are built. Efficiency, leverage, hedging, speculation, liquidity. But when volatility rises, or when the exchange smells disorder, it raises the cost of that leverage. That triggers liquidations. It forces weak hands out. It turns a crowded trade into a stampede. And here's the twist you need to hold in your mind. Margin hikes can smash paper price short term even while the physical market is tightening underneath. That's the part that confuses people. They watch the chart dip and they assume the shortage story was false. No, sometimes the chart dips because the paper market is being forced to cough up collateral. And the quickest way to do that is to close positions. Sell what you can sell while the physical market keeps whispering that the real stuff is harder to source. That's not a contradiction. That's the split. That's the system showing you two different realities at once. One is the world of leveraged claims. The other is the world of actual metal. And if you've never lived through a split like that, you won't respect how violently it can resolve. Ask anyone who watched the nickel squeeze. That was a market where the paper structure got stressed to the point where the exchange had to intervene in ways that would have been unthinkable in normal times. Trades canceled, rules bent. The sanctity of the market sacrificed to prevent a cascade. You don't need to memorize the details. You just need to understand the pattern. When a market is structurally overlevered, when the claim stack gets tall, the system becomes allergic to delivery stress and violent repricing. It will do almost anything to preserve order. And order is not the same as fairness. Order means the system survives. Now, let's bring in the retail premium because this is where you can feel the truth with your fingertips. A Silver Eagle listed at around $86 while futures are near $75 is not just a premium. It's a message. It's the physical market saying, if you want out of the paper world, it costs extra. That's the escape tax. And the escape tax is never stable. It grows during stress. It grows when people don't trust settlement. It grows when supply chains tighten. It grows when mints, wholesalers, and dealers can't restock as easily. It grows when demand isn't speculative but protective. When buyers aren't trying to flip, they're trying to own. Most people only learn about the escape tax after it spikes. After they decide, in a panic, that they should convert exposure into metal, and they discover the spread has widened into a canyon. So ask yourself, why would a rational market price a 1-ounce coin that far above the official price price? Because the official price is the price of a contract. The coin is a different product, different logistics, different costs, different margins, sure. But that's not the whole answer, and you know it. The whole answer is that when stress rises, physical becomes the final settlement layer. And final settlement layers always command a premium when people start doubting the layers above them. That's what's happening when you see a high premium with demand and delay language. It's not hype. It's the market quietly repricing certainty. And certainty is always scarce right before the system fractures. Now, while all of this is building, registered inventories, ETF scale, margin tightening, physical premiums, there's another layer, a darker layer, that makes metals behave the way they do, geopolitics and enforcement. You've got actions like Switzerland freezing assets linked to the Venezuelan leadership after a U.S. capture. On the surface, that's a political story, a foreign story, something you scroll past. But from a macro perspective, from a capital flow perspective, it's a reminder of something that every serious player understands and every retail participant pretends isn't true. In the modern financial system, ownership is conditional. Conditional on jurisdiction, conditional on compliance, conditional on the political weather. Assets get frozen, accounts get restricted, transfers get questioned, counterparties get sanctioned, payment rails get severed. And every time that happens, it injects one more unit of distrust into the bloodstream of the system. Not everyone reacts the same way. Some people double down on the system because they're re-insiders and they think they can navigate it. Others, quietly, professionally, start shifting toward assets that are harder to freeze, harder to censor, harder to seize. Gold is the classic version of that trade. Silver is the more volatile cousin that people ignore until it's too late. And if you think I'm being dramatic, let me frame it the way the world actually works during stress. When governments, banks, and institutions feel threatened, they don't ask your permission. They change rules, they adjust capital controls, they rewrite the line between legal and illegal. They call it temporary, they call it necessary, they call it stability. And it always starts over there. Some foreign country, some sanctioned person, some bad actor. Until one day it's closer. Until one day it's a sector. Until one day it's a behavior. Until one day it's a bank run, a liquidity crunch, an emergency policy, a weekend decision. That's why the metals narrative never really dies. Because it's not just about inflation. It's about sovereignty over your own savings. It's about holding something that isn't someone else's liability. And silver, for all its quirks, sits right at the intersection of monetary distrust and industrial necessity, which is why these signals matter. Now I want you to zoom out and see the shape of the storm. Registered silver around 126 million ounces. Deliverable inventory not collapsing to zero, but sitting in a zone where you can't pretend it's infinite. SLV reporting over 500 million ounces in the trust, an enormous paperized pile that dwarfs the visible deliverable layer everyone watches. A physical coin market that's charging a hefty escape tax relative to futures, with demand pressure and delays. An exchange that keeps raising the cost of leverage, forcing the paper players to hold more collateral just to stay in the game. A major supply chain node building a licensing valve around refined silver exports. And geopolitical enforcement reminding capital everywhere that accounts and assets can be frozen when politics decides they should be. Put it together, and you're not looking at a single bullish headline. You're looking at a regime shift. A shift from the fantasy of infinite liquidity to the reality of constrained collateral. And silver, whether the mainstream wants to admit it or not, is a collateral story now, because the modern world is starving for collateral. Debt is massive, balance sheets are bloated, derivatives are stacked. And whenever the system gets nervous, it hunts for assets that can serve as real settlement, assets that aren't just promises. That's why central banks hoard gold, and that's why, at the margins, the industrial world hoards silver when it smells constraint. This isn't risk management. This is an evacuation. Not everyone is evacuating yet. That's not what I'm saying. But the signs that precede evacuations are here. Rule changes, premiums, tightening valves, and shrinking deliverable buffers. And you don't ignore that. Now, let's talk about how this can break, because this is where people either get serious or they drift back into complacency. Silver doesn't usually break in a clean line. It breaks through feedback loops. Here's how the feedback loop starts. A supply constraint appears, or the perception of a supply constraint appears. It might be registered inventory tightening. It might be industrial demand rising. It might be export friction. It might be a big buyer stepping in quietly that pushes volatility up. When volatility rises, the exchange hikes margins. Margin hikes force leverage players to post more collateral or reduce positions. Reducing positions can push the paper price down even as the underlying physical tightness persists. That confuses the public. The public thinks the story is over. But behind the scenes, the physical market doesn't get more supplied just because paper players delever. In fact, sometimes the opposite happens. Physical demand rises because the very fact that the paper market is volatile and unstable makes people want metal more, not less. That widens premiums. Premiums widening becomes visible. Retail buyers see it. They panic late. They buy late. They pay the escape tax. That creates even more strain on retail supply channels. Then the story hits social media. Shortage. Squeeze. Default. Whether the language is accurate or not, the behavior becomes self-reinforcing. More people try to grab physical, fewer are willing to part with it at the official price, and the difference between paper and physical grows. Meanwhile, big players, industrial users, large custodians, sophisticated funds start thinking about their own exposure, not price exposure, delivery exposure, supply assurance, counterparty certainty. And this is where the system gets dangerous because sophisticated actors don't move like retail. They don't announce. They don't shout. They quietly shift. They quietly secure. They quietly reduce reliance on the most fragile layers. And when they do that, the fragile layers start to wobble. In markets, wobble becomes a cascade faster than anyone expects. First in whispers, then in numbers, then all at once. This is why I keep coming back to that registered number. It's not that 126 million ounces is nothing. It's that it's a finite buffer under a potentially enormous claim stack. And finite buffers are exactly what break during stress events. The public thinks markets break because of emotion. Real breaks happen because buffers are too small for the flow that hits them. Now, I want to address a mistake people make when they hear this. They assume the endgame is some Hollywood moment where COMEX defaults in a single day and everyone wakes up to a new world. That's not how systems protect themselves. If stress hits, the system has options. It can cash settle more aggressively. It can change delivery incentives. It can adjust contract rules. It can hike margins harder. It can coordinate with liquidity providers. It can do what it has always done, prioritize continuity over purity. So if you're waiting for a dramatic announcement, you might wait forever. The real break, the one that matters, can happen without a press release. It happens when the market slowly teaches participants that physical certainty is worth more than paper price. It happens when the premium becomes permanent. It happens when delivery becomes harder, slower, more negotiated. It happens when the official price becomes less relevant to real procurement. That's not a blip in the chart. That's a crack in the foundation. And China, yes, licensing valve matters here because the industrial side of silver demand is in T optional. Solar panels don't care about your narratives. Electronics don't care about your political opinions. Manufacturing lines run on inputs, and when inputs tighten, companies pay up or they stop producing. If refined, silver export friction increases, whether intentionally, accidentally, or as a side effect of bureaucracy, then the real-world procurement pressure rises. And procurement pressure doesn't express itself first in the futures price. It expresses itself in availability, lead times, premiums, and back orders, which is exactly what you're seeing at the retail level. And when industrial procurement pressure rises, at the same time that investors start treating silver like a monetary escape valve, you get the kind of squeeze dynamic that doesn't look neat on a chart. It looks jagged, violent, unfair, because it's two different worlds competing for the same atoms. Now layer in margin hikes and you can see the trap. Paper traders get squeezed by collateral demands. Physical buyers get squeezed by availability and premiums. Industrial users get squeezed by procurement risk. And the exchange, sitting in the middle, is trying to keep the paper casino from becoming an embarrassment. That's the setup for a structural break. And then you add the geopolitical layer, the asset freezes, the sanctions, the seizures, and you've got the psychological accelerant. You've got the reminder that your wealth inside the system comes with strings. So the question becomes, when enough people sense that, where do they go? They go to what feels outside the system. That's why physical metal keeps showing up every time trust erodes. Now let's talk about you, because the stakes aren't academic. Most people are positioned for normal times. They're positioned for stability, for liquidity, for the assumption that markets always clear cleanly and price discovery always works. But in regimes like this, the real risk isn't volatility. The real risk is category error. Thinking your asset is one thing when it's actually another. So ask yourself, are you holding metal or are you holding a claim that references metal? And don't dodge the question, because in calm markets, the difference feels petty. In stressed markets, the difference is everything. This isn't about telling you what to buy. This is about telling you what the system is signaling so you don't get trapped in the wrong layer when the layers start to separate. If you're holding only paper exposure, you need to understand what happens when settlement gets stressed. You need to understand that liquidity can vanish at the exact moment you try to use it. Not because the screen stopped updating, but because counterparties step back and rules tighten. If you already have physical, you need to understand what paper chaos actually means for you. It can mean your net worth swings violently. It can mean premiums widen. It can mean you re-holding something that becomes more valuable precisely because the system becomes less trustworthy. Either way, you need the correct mental model, because the wrong mental model is how people become the exit liquidity. And I've watched this happen enough times to know the emotional arc. First, the mainstream dismisses the signals. Then, when the price moves, they call it a speculative frenzy. Then, when the price falls on margin liquidations, they declare it over. Then, when physical tightness persists, they ignore it because it's not on their Bloomberg terminal in a neat, polite number. Then, later, months later sometimes, when the regime shift becomes undeniable, they talk about it like it was obvious the whole time. But you don't get paid for being late to what becomes obvious. You get paid, financially or psychologically, for seeing the stress when it's still deniable. And right now, the stress is deniable. That's why it's so dangerous. Because deniable stress is exactly when you still have choices. Later, you won't. Now, let me connect one more dot for you, because it's the dot that turns this from a silver story into a monetary story. The world is not just dealing with commodity cycles. The world is dealing with confidence cycles. Confidence in currencies, confidence in sovereign debt, confidence in institutions. Every time you see asset freezes and sanctions expand, you are watching confidence get politicized. Every time you see exchanges hike margins repeatedly, you're watching confidence get collateralized. Every time you see export licensing valves appear, you are watching confidence get nationalized. And when confidence gets squeezed like that, money looks for exit routes. Some of that flow goes to gold, some of that flow goes to hard assets, and some of that flow, especially when people want upside and they want something that still feels cheap relative to gold, goes to silver. Silver is the metal people rediscover when the room starts to smell like smoke, and the room is starting to smell like smoke. Not because the world ends tomorrow, but because the system's behavior is changing. Tightening, controlling, rationing, collateralizing. So here is the guiding question I want you to hold as we move into the next weeks and months. What are the big players seeing that you're not? Because big players don't wait for retail headlines. They don't wait for YouTube thumbnails. They don't wait for the evening news. They watch the plumbing. They watch inventories. They watch premiums. They watch rules. And when rules start changing, they respect it. You should too. Now, think about the retail premium again, because it's the most visceral proof you can hold up against the official story. If the official price is the truth, why are people paying a 15-ish% escape tax for a 1-ounce coin? And don't you let anyone hand wave it away with minting costs and dealer spreads like that? Hence the whole story. Those costs exist, sure, but costs don't suddenly feel like a crisis premium unless demand is pressuring a constrained channel. And demand doesn't pressure a channel unless buyers are prioritizing certainty. That's what you're watching, a certainty bid. And certainty bids don't show up when people feel safe. They show up when people feel exposed. Exposure. That word matters. Because most people think they're diversified. They're not. They're diversified across paper claims that all depend on the same settlement system, different wrappers, same core dependency. And when you see assets frozen in geopolitics, when you see margin rules change in markets, when you see export valves added in supply chains, you are seeing reminders that the system can and will assert control at exactly the moments you prefer it, didn't it? So the real question isn't whether silver is manipulated. That's the wrong obsession. The real question is whether the structure can handle a shift in behavior from paper trading to physical preference without breaking its own credibility. Because if the structure can't handle that shift, you don't get a gentle repricing, you get a snap. And snaps don't give you time to think. You don't have years to think this through. You barely have months. In markets like this, sometimes you only get weeks. Now, I'm going to say something that will irritate both the complacent and the fanatics. Silver can be brutal. It can rip your face off in both directions. It can soar and then punish you. It can collapse on paper while physical stays stubborn. It can gap on headlines. It can get used as collateral in games you'll never see. That's true. But brutal markets are exactly where structural signals matter most, because price alone becomes a liar. Price becomes a battlefield outcome, not a clean reflection of fundamentals. So if you're only watching the chart, you're fighting blind. Watch the stress signals, registered inventory, premiums, margin changes, supply chain valves, geopolitical enforcement. These are the early warnings. These are the fault lines, and when fault lines start moving together, you don't need an earthquake forecast to know you're in the danger zone. That would be bad enough by itself, but it doesn't stop there. Because the ETF pile, the 500 million ounces in SLV, adds another layer of potential instability, not necessarily because it's fraudulent, but because it concentrates perception and exposure in a single structure. In calm markets, that structure is a convenience. In stressed markets, it becomes a focal point for fear. What happens if retail investors, spooked by volatility and geopolitics, try to stampede into silver exposure through the easiest door? They buy the ETF. That pushes the ETF to source more metal, or at least to manage its structure in ways that can ripple through the physical market. What happens if volatility then forces the paper market down, and those same investors panic out? The ETF becomes a flow amplifier, a pump and a drain. And when you have pump and drain dynamics tied to a physical metal with constrained procurement channels, you get whiplash. Whiplash breaks weak hands. Whiplash creates headlines, and headlines attract late money. Late money is always the fuel for the next violent move. This is the kind of pattern you see before a market implodes, or before it reprices violently upward, sometimes both in sequence. And the exchange knows it. That's why margins are being tightened. That's why the system is bracing. So let me translate the whole briefing into one sentence you can keep in your pocket. The silver market is showing signs of a split between paper price and physical reality, and the institutions are tightening rules because they can feel the strain. That's your warning. Now, what do you do with that warning? You don't chase headlines. You don't let emotion drive you. You don't assume you can react later. You build a framework. If you're a trader, you respect volatility and you respect the exchange's power to change leverage conditions. You don't pretend the rules are fixed. You don't get married to a position. If you're an investor, you respect the difference between exposure and ownership. You respect premiums as signals. You respect that physical markets can tighten even when paper charts look bearish. If you're simply trying to protect your savings in a world that feels increasingly unstable, you stop asking, is silver going up tomorrow? And you start asking, what happens to claims when settlement gets stressed? Because the biggest mistake people make is thinking a crisis announces itself. It doesn't. It whispers, then it mutters, then it shouts, then it happens. And right now it's whispering in the data. Registered inventory is the whisper. Retail premiums are the mutter. Margin hikes are the shout. Geopolitical asset freezes are the reminder that, in the system, control can arrive suddenly. And China's export licensing valve is the quiet structural move that makes future constraints easier to enforce. You can ignore one of these, you can rationalize two. But when they show up together in the same window, you're looking at a coordinated message from reality. The system is tightening, and systems that tighten don't usually loosen gently. They tighten until something gives. So ask yourself one last question and answer it like your financial future depends on it. Because in regimes like this, it might. When the next wave hits, when volatility spikes again, when margins ratchet higher, when premiums widen, when the mainstream shrugs and then suddenly panics, do you want to be the person trying to move through a narrowing door? Or do you want to be the person who saw the door narrowing while everyone else was still arguing about the paint color? Because you do have a window. It's not measured in decades. It may not even be measured in years. And once that window closes, the market won't care how confident you felt 5 minutes earlier. It will only care what you actually hold. That's the end game. Claims versus collateral. Paper versus physical. And the people who understand that before the crowd are the ones who ought done to get crushed when the room finally realizes the air is running out. You don't need to panic, but you do need to wake up, because this isn't a dip, it's a dress rehearsal.